Let's pull back the curtain on a completely legal, highly orchestrated system used by the ultra-wealthy to literally erase their tax burdens. We're talking about a strategy called buy, borrow, die. It's this hidden mechanism that lets titans like Jeff Bezos and Elon Musk watch their net worth skyrocket by billions, yet somehow pay exactly $0 in federal income tax in certain years. Sounds totally impossible, right? But it is baked right into the US tax code. Let's look at the data. Just look at the sheer scale of this contrast. If you're a typical middle-class earner, almost all of your wealth growth is taxed as salary. Over a recent 5-year period, a standard middle-class household grew their net worth by about $65,000, but they paid nearly $62,000 in taxes. Your taxes almost perfectly cancel out your wealth accumulation. But for the top 25 billionaires, over that exact same period, their wealth exploded by an astonishing $401 billion, yet they paid only $13.6 billion in taxes.
According to leaked IRS data analyzed by ProPublica, that breaks down to a true tax rate of just 3.4%. So, while a typical worker might fork over 20 or 30% of their income to the government, the ultra-wealthy are paying absolute pennies on the dollar relative to their newly acquired wealth. We're talking about the absolute titans of industry here. Warren Buffett, over $24 billion in wealth growth, but a true tax rate of 0.10%. Jeff Bezos saw $99 billion in wealth growth, with a true tax rate of less than 1%. In fact, Bezos managed to pay exactly $0 in federal income tax in 2007 and 2011. Elon Musk paid $0 in 2018. So the billion-dollar question is, how do you add billions to your net worth and owe the IRS literally nothing?
Chapter 1. The buy phase, unrealized gains versus income.
This entire strategy hinges on one fundamental rule that actually dates back to a 1920s Supreme Court ruling. The United States government taxes your income, not your wealth. In the eyes of the IRS, if you buy a stock and it goes up in value from $10 to $1,000, sure, you're vastly wealthier on paper. But that gain is what they call unrealized. Until you hit the sell button, the IRS considers your taxable income on that growth to be absolute zero. So the magic trick is incredibly simple. Never sell. You buy appreciating assets and you just hold on to them. To really put this into perspective, think about 2021. Elon Musk's net worth grew by roughly $121 billion that year. The income tax he owed on that specific, massive growth? Zero. Because he simply held on to his appreciating Tesla stock, that's the buy phase of our life cycle, he avoided triggering any sort of taxable event. He kept his fortune entirely intact and the IRS completely out of the picture.
Chapter 2. The borrow phase, SBLOC and margin loans.
Okay, so if all their wealth is trapped in unsold stock, how do billionaires actually buy mansions, super yachts, or, whole social media networks? If they sell stock to get cash, they trigger a massive 20% capital gains tax. Instead, they treat their stock portfolios like giant tax-free credit cards. First, they pledge their appreciated stock to a major bank as collateral. Next, the bank extends a Securities-Backed Line of Credit, or an SBLOC. And finally, they just spend the cash. Because the IRS explicitly dictates that borrowed money isn't taxable income, that cash hits their bank accounts completely tax-free.
It really just comes down to pure math. Say you need $1 million. Option A, sell your stock and immediately hand the government roughly 20% in capital gains tax. Option B, borrow $1 million against your stock. You pay zero in taxes and simply owe the bank a low single-digit interest rate, often around 4%. Paying 4% to a bank is drastically cheaper than handing 20% to the IRS. Plus, your underlying stock just continues to grow in the background.
And this isn't just theory, it's standard operating procedure for the ultra-rich. Elon Musk pledged roughly 92 million Tesla shares to secure personal loans, funding things like his purchase of Twitter. Carl Icahn reported adjusted gross income in the hundreds of millions, but paid $0 in federal tax in 2016 and 2017, all while casually holding on to an outstanding loan of $1.2 billion. Larry Ellison secured a massive credit line backed by $10 billion of Oracle shares. By borrowing billions against their unrealized gains, they secure liquid cash to fund lavish lifestyles while their fortunes just keep compounding undisturbed. Now you might be wondering, wait a second, loans eventually have to be repaid, right? If they're just borrowing money year after year to live tax-free, aren't they just delaying an inevitable, massive tax bill when they finally have to sell stock to pay off those banks? It's a great question. But this is exactly where the strategy shifts from just delaying taxes to permanently eliminating them.
Chapter 3.
The die phase, the step-up in basis loophole.
The climax of this whole life cycle happens upon death, thanks to one of the most powerful and controversial provisions hidden deep within the U.S. tax code, the step-up in basis. Under Section 1014, when a person dies and passes their assets to their heirs, the tax system actually resets the cost basis, which is the original purchase price, to whatever the fair market value is on the exact day of their death. So what does this mean? It effectively erases all the taxable capital gains that accumulated over their entire lifetime. Poof, gone.
So here's how that mountain of debt is finally settled. Imagine a billionaire buys stock for $100 million. Over their lifetime, it grows to $10 billion. That's $9.9 billion in untaxed, unrealized growth that they borrow against to live on. When they die, their heirs inherit the portfolio, and the IRS resets that purchase price to the full $10 billion. If the heirs sell $2 billion worth of stock the very next day to pay off all those accumulated bank loans, their taxable gain on that sale is exactly zero. That entire lifetime of borrowing is paid off tax-free, and decades of massive wealth accumulation are permanently forgiven.
Chapter 4. The System Design and Reform Debate.
It's incredibly important to note here that this isn't accidental tax evasion. This is a strictly legal exploitation of a system intentionally designed and maintained by Congress. Reports from the Congressional Budget Office and the National Taxpayers Union reveal that the sheer bureaucratic weight of our tax code basically entrenches this system. The step-up in basis, for instance, originally existed partly to prevent double taxation, getting hit with both an estate tax and a capital gains tax, and to solve massive record-keeping headaches for heirs. Fixing this requires navigating some pretty huge economic trade-offs.
Policymakers have floated various solutions to close this. One option on the table is the Billionaire Income Tax Act, which aims to tax the unrealized gains of the ultra-wealthy on an annual basis, whether they sell stock or not. Another proposal from institutions like the Yale Budget Lab suggests a deemed realization approach. This basically means legally treating a massive collateralized loan as if the stock was actually sold, which would trigger a tax bill. And finally, many propose just eliminating the step-up in basis altogether.
However, closing these avenues carries severe economic risks that genuinely concern analysts. For example, securities-backed lines of credit aren't just for buying mega yachts. Cash-poor entrepreneurs use them to fund new startups without giving up control of their companies. Plus, if you eliminate the step-up in basis without making really careful exceptions, you might accidentally force heirs to liquidate family businesses or farms just to pay the sudden tax bill. And on a macro scale, taxing unrealized gains risks triggering catastrophic market sell-offs. I mean, we've seen what happens when massive portfolios are forced to liquidate quickly. Just look at the spectacular implosion of Bill Hwang's Archegos Capital. Forcing billionaires to mass sell stock to pay annual tax bills could literally destabilize the entire stock market.
Despite those very real macroeconomic risks, a growing consensus of economists across the political spectrum view the step-up in basis as an indefensible driver of extreme wealth concentration. As this quote captures perfectly, it is potentially the single largest tax advantage in the American tax code that most people have never heard of. Critics argue it basically creates a two-tiered system, one for people who earn their money through wages, and another entirely for those whose wealth is vast enough to be leveraged into tax-free debt.
So the crucial takeaway from all of this is really a philosophical question. Can a system that only taxes income ever truly capture the reality of modern wealth? As long as the tax code rewards debt and permanently forgives accumulated wealth at the moment of death, the ultra-rich are going to continue to legally buy, borrow, and die. It leaves us to wonder if the rules of the game will ever be rewritten, or if the chasm between wage earners and asset holders will just continue to grow.